Hey guys, Jason Etters here, back at it. Your VA loan expert, I like to call myself. Today, let's talk about residual income. You've probably heard about it on a VA loan. Um, what is residual income? What does it mean? How does it affect your clients? Whether you're mostly, someone using their VA loan to purchase a home or to refinance, technically. So residual income is a guideline that VA has. VA is the only product that has it. FHA does use it if it's a manual underwrite, but that's it, or for compensating factors. So for VA, they use it to determine that the veteran can afford the house. So if you know anything about a VA loan, you know that debt ratios, you can go super high on debt ratios of VA loan. It's one of the huge benefits for VA. Um, I've seen loans go as high as 65, 70% debt ratio. Again, it's completely person to person, situation to situation based. So it's not something that is common, but you can go very high on debt ratios for VA. The reason they allow that is because as long as they're meeting the residual income guideline, the VA is more concerned about residual income than they are about debt ratio. And that's why in manual underwrites, like Flat Branch doesn't have an overlay for debt ratio on manual underwrites. We can go as high as we want as long as we're meeting residual income. So, what is residual income? Residual income is essentially this: how much money does the veteran have left over after paying all their debts and liabilities, the new house payment, and then there is a maintenance factor or utilities factor that factors in, and then also we're going to net out their taxes. So we're going to take their deductions from their pay stubs out, so we get a net pay, not a gross pay. And then that number left over has to meet or exceed the minimum requirement. So what are the requirements? Requirements are out there. You can Google it. Google VA residual chart 2022, 2023. They're out there. Essentially, one person in the north, they have to have $450 left over at the end of the month. In the Midwest, it's $441. In the South, it's $441. And in the West, it's $491. For an example, if you have 4 people in your household, you need in the North 1,025, in the Midwest and the South 1,003, and in the West 1,017. If you have over 4 people in the household, for each person above that, up to 7, a household of 7, you have to add $80 per month in residual. Okay, so what does all that mean? So when we take all the deductions out of their net pay, that's the amount of money they have to have left over. So how do we figure it? The utility factor, it's 14 cents per square foot. So the larger the house, the bigger that deduction will be, based off of their residual income. So the way it works, for instance, like you have a client, and they, make $3,000 a month, whatever it may be. I don't care. We're going to take all those payroll deductions out, like taxes, Social Security, Medicare, things like that. We're going to deduct their current house payment. We're going to deduct all their debts and liabilities, and then that amount left over has to exceed the guideline. It's easy to do on my end because we have a system that we can plug numbers into, and it does it kind of for us automatically. So what do you have to look out for? You want to look out for the lower income families, because those are the ones that are harder to meet residual. So if someone's making $10, $15, $20,000 a month, they're almost always going to meet the residual requirement, even with higher debt ratios, because they've got leftover money, available to them. If you're on Social Security or VA disability or something like that, sometimes those can get tougher to hit because that fixed income or a pension or something, that fixed income can be a little bit lower, and so that debt ratio or that residual income becomes a bigger factor to hit. So, I would say when you're communicating with me or your lender about, getting them approved, I want to be your lender, so, come to me. But when you're communicating with them about a client that you have coming over, you might just say, hey, they're on a fixed income, or just, make sure we're meeting the residual requirement, just to kind of cue them. You don't have to do that with me. I know how to do residual. I do it all the time. I check it for every client. I know which clients are probably going to be a struggle to hit it and which clients aren't. But that is what residual income is on a VA loan. If this loan is a manual underwrite, which happens from time to time, we can do manual underwrite VA loans. If it is a manual underwrite, that residual income gets bumped up by 120%. So you have to multiply the amount by 1.2 to get the new residual income required. Again, if you guys have questions, my cell phone's 573-424-8817. You can message me on Facebook. You can message me on Instagram, whatever way you can find me, you can message me. Google my name. It's out there. It's pretty easy to find. Jason Etters here. Thank you guys. Look forward to the next one. We'll see you later.